Hey everyone, welcome back to Sara Retires. Imagine carefully planning your retirement budget, only to discover an unexpected Medicare surcharge, one tied to your income from 2 years earlier. Surprising, unwelcome, and honestly avoidable if you know what's coming. The culprit is something called IRMAA, the Income-Related Monthly Adjustment Amount. Today, I'm breaking down exactly what it is, how it's calculated, real examples of how much it can cost you, and, most importantly, how to plan around it so it never catches you off guard. I'm Sara. This is Sara Retires. Let's get into it. Medicare Basics. Where does IRMAA actually apply? Medicare is health insurance for people 65 and older, and it comes in multiple parts, each with its own cost structure, and IRMAA doesn't apply evenly across all of them. Part A covers hospital insurance. Most people get this premium free, since it's funded through payroll taxes over your working life. IRMAA does not affect Part A at all. Part B covers medical insurance, and for 2026, the standard premium is $202.90 a month. This is where IRMAA kicks in for higher earners. Part D covers prescription drug coverage, with a national average base premium of roughly $34.50 a month, and this also gets adjusted upward under IRMAA for higher incomes. And a quick aside on Part C, it technically exists, though almost nobody calls it that. You know it as Medicare Advantage, administered by private insurance companies and approved by Medicare. IRMAA does not apply to Medicare Advantage plans directly, so that's not our focus today. The two-year look-back, the part that surprises people most. Here's the detail that catches so many retirees off guard. IRMAA is based on your modified adjusted gross income from your tax return filed 2 years prior. For 2026, IRMAA determinations are based on your 2024 tax return. In 2027, they'll be based on your 2025 return. It's always a 2-year look-back, no matter what year you're in. Here's a simple way to think about it. Your income at 63 determines your Medicare premiums at 65. Your income at 64 determines your premiums at 66. This matters enormously for people who are still working right up to retirement, because those final working years are often someone's peak earning years, and that peak income can quietly set your Medicare costs 2 years down the road, sometimes right as you're adjusting to a fixed retirement income. The 2026 IRMAA Brackets. Let's look at the actual numbers for 2026. The first IRMAA threshold kicks in at $109,000 in modified adjusted gross income for single filers, and $218,000 for married couples filing jointly. Cross that threshold and your monthly Part B premium, remember the standard is $202.90, increases based on which of 5 income tiers you fall into. Across those tiers, the added Part B surcharge ranges from about $81.20 up to $487.00 a month on top of the standard premium, meaning total Part B premiums can range from roughly $284 all the way up to nearly $690 a month, depending on income. Part D surcharges add anywhere from about $14.50 to $91.00 a month on top of your plan's regular premium. The top bracket applies at $500,000 in income for single filers and $750,000 for married couples filing jointly. One critical thing to understand, unlike ordinary income tax brackets, IRMAA works on a cliff system, not a gradual phase-in. Exceed a threshold by even $1 and you owe the full surcharge for that entire tier, not just on the amount over the line. That single detail is exactly why careful income planning matters so much here. And remember, for married couples, each of these premium amounts applies per person, so a couple both enrolled in Medicare could see this surcharge doubled across their household. 3 real-world examples. Let's walk through this with a few illustrative examples, using the 2026 numbers and a 2-year look-back. Example 1. A couple below the threshold. Say Ben and Sue, married filing jointly, had a household income of $100,000 back in 2024. That's below the $218,000 threshold, so no IRMAA surcharge applies. Each of them pays the standard $202.90 for Part B and around $34.50 for Part D. Worth remembering, this doesn't include any additional costs from a Medicare Advantage or supplemental plan they might also be paying for. Healthcare is still a meaningful line item in most retirement budgets, even without IRMAA in the picture. Example 2. A couple solidly above the threshold. Say William and Jane had a household income of $275,000 back in 2024. That places them into one of the higher IRMAA tiers, meaning each of them would pay a noticeably higher Part B premium, potentially in the range of $350 to $400 plus a month per person, plus an elevated Part D surcharge. Multiply that across two people for a full year, and their combined Medicare costs alone can easily exceed $10,000 to $12,000 annually, well before adding any supplemental plan costs. Example 3. A one-time income spike. This is the one that catches the most people off guard. Say Max and Emma had a fairly modest income most years, but in one specific year, they withdrew a large lump sum from a traditional retirement account, say $170,000, pushing that year's household income up to around $270,000. 2 years later, both of them get hit with significantly higher Part B and Part D premiums, even though their income has already dropped back down to normal. Then, once that inflated income year rolls out of the 2-year lookback window, their premiums drop back to standard levels. The lesson here: a single unusual income year, a big Roth conversion, a large capital gain, an unusually large withdrawal can spike your Medicare costs 2 full years later, even after your actual income has returned to normal. You'll get a letter, and you can appeal it. If your income crosses one of these thresholds, you'll receive an initial determination notice from the Social Security Administration, explaining the surcharge and the reason for it. Here's something worth knowing. The Social Security Administration isn't immune to errors. If you receive a notice you believe is incorrect, or if you've had a life-changing event that reduced your income, like retirement itself, a marriage, divorce, or the death of a spouse, you can file an appeal using the SSA's Request for Reconsideration form, sometimes called a life-changing event form. Many people don't realize this option exists, and legitimate appeals based on real-life changes are approved at a meaningfully high rate. How to actually plan around IRMAA. So how do you avoid getting blindsided by this? It comes down to proactive income management. Several income sources can trigger IRMAA. Withdrawals from a traditional 401k or IRA, the taxable portion of your Social Security benefit, pension income, capital gains, dividends, and rental income all count toward the modified adjusted gross income that determines your bracket. Here's the genuinely good news. Withdrawals from a Roth account do not count toward IRMAA at all, since they're already tax-free. That makes having multiple types of accounts, tax-deferred, taxable, and tax-free, genuinely valuable, because it gives you real flexibility in choosing which bucket to draw from in any given year to manage your reported income. This is exactly why a smart, coordinated withdrawal strategy matters so much in retirement, not just for minimizing your income taxes, but specifically to avoid accidentally tipping yourself into a higher IRMAA tier and paying meaningfully more for Medicare than necessary. And remember that cliff effect from earlier. Crossing a threshold by even a small amount can trigger the full surcharge for that tier, so this is exactly the kind of situation where careful planning, especially around big one-time events like Roth conversions or large withdrawals, pays off substantially. The particularly tricky scenario: retiring while still earning peak income. Here's a scenario worth flagging specifically. If you're planning to retire soon but you're still working right now, be aware that your current, possibly peak career income is what will determine your Medicare premiums 2 years from now, even if your income drops significantly the moment you actually retire. This means the timing of major financial moves, a big bonus, a large capital gain, a substantial Roth conversion, deserves extra scrutiny in the years immediately leading up to your Medicare enrollment at 65, since those are exactly the years that will show up in your future IRMAA lookback. Why this matters so much for your retirement budget. Let's zoom out. Healthcare costs are already one of the biggest and most unpredictable line items in most retirement budgets. IRMAA adds a layer most people don't see coming, a surcharge that isn't based on your current income, doesn't phase in gradually, and can be triggered by decisions made years before you even feel the consequence. The financial impact is real. As we saw in our examples, a single unusual income year can add thousands of dollars in extra Medicare costs, spread across a full year, sometimes recurring if the elevated income period lasts more than a single tax year. The best defense is simply awareness paired with planning, knowing these thresholds exist, understanding the two-year lookback, and factoring IRMAA into decisions like Roth conversions, large withdrawals, or asset sales well before you're actually in the middle of your Medicare years. The honest takeaway. Planning for retirement is about far more than just saving enough money. It's about understanding how all these pieces interact. Your income today can quietly determine your healthcare costs years down the road, and a withdrawal strategy that ignores this can end up costing you real money in premiums you never needed to pay. The reassuring part: this is entirely plannable. Understanding your income sources, spreading withdrawals thoughtfully across taxable, tax-deferred, and tax-free accounts, and being deliberate about timing large one-time income events can meaningfully reduce your risk of an unwelcome IRMAA surprise. This isn't personalized financial or tax advice. Every household's income sources and thresholds are different, but understanding this mechanism gives you a genuinely useful framework for a conversation with a financial planner well before you enroll in Medicare. If this helped make sense of a cost that catches so many retirees off guard, that's exactly what this channel is here for. Hit subscribe because I'll keep covering the retirement costs that don't get talked about enough until they actually show up. Drop a comment and let me know. Has IRMAA affected you already, or is this something new you're now watching out for? I read every comment, so I'll see you down there. This is Sara Retires. I'll see you in the next one.